So fair market value is looking at a lot of different things. It might actually weight different factors as to come up with an appraised value. It might look at these different factors, including comparable sales of businesses in the marketplace, and throw out one of the factors because it's really not reflective of the fair value of that business. And then you get into the question of fair value without the word market in between. Fair value is a standard that means different things in different states for different purposes. So if you ever see a buy-sell formula or a shareholder agreement or any other type of buyout that says fair value without the word market in it, beware. It has to be defined. Fair value is a concept that's used under state law in Delaware, Virginia, and most other states, but defined differently from state to state, to figure out what an oppressed minority shareholder would get if there is a dissenting right action, an appraisal action. Appraisal action is actually a state law action that a minority shareholder may file if there's a merger and they disagree with the price that's being paid for the company. So fair value is a state law concept which is developed under court cases within that state or across the United States. It's also a concept that's used in generally accepted accounting principles, GAAP. So for fair value, in valuing a business, if an asset on a balance sheet is not being shown at fair value, it requires that there be a write-off of the asset. The business has to write it off. So the fair value is used in GAAP for a variety of purposes, but primarily you see it in the valuation of assets on a balance sheet of a company that's bought another business. So fair value is a dangerous concept to use unless you actually define what you mean. But the most important thing is if you use fair market value, do you intend to discount a minority interest because it's a minority interest? You have to state that in the buy-sell. If you don't, fair market value automatically assumes that you will discount the minority interest. If the interest is not marketable because it's a privately held company and there's a shareholders agreement or a buy-sell agreement that says you can't sell it without the permission of the other owner, or there's a right of first refusal in that agreement, that will cause the value to be depressed because it's less marketable. Having those types of restrictions on equity will cause the value to be depressed because it's less marketable. So the value swing could be anywhere from 100% of the interest down to 60 or 50% of the interest. That's a big value swing because of the discount. The other thing that fair market value does take into consideration is that if you're valuing a majority interest that has control, then you may have to assign a control premium to that interest. So if it's 60% of the business, under appraisal standards, it may actually come out to be 75% of the value of the business because it's in that control position. So your buy-sell agreements for your clients, when you're looking at them, you better make sure that you're looking at it with an eye to say, well, what does my client really want here and what should they get here in terms of fair market value? Because if you don't define it, the appraisers are going to come in and define it for you, and that may not result in the result that you want. The level of value is really referring to the control versus a minority interest. And minority interests can be marketable. So you may have a shareholders agreement that has a required buyback of a minority shareholder, a put. So the minority shareholder may have a put to force the sale of his interest back to the company. That makes it marketable. What if it's in a publicly traded company and it's a minority interest? It may be marketable, right? So you won't necessarily claim a discount for marketability in that instance. If it's non-marketable, that's when you have the additional discount. Another important factor in every buy-sell agreement, every shareholders agreement, every valuation that you're dealing with, every phantom stock plan, every restricted stock agreement, what is the date on which we're doing this valuation? Where I've seen a lot of these agreements fall short is being very specific about the date. They'll say, you know, the trigger date, the trigger event date. It doesn't really define. Is it the date of death? Is it the end of the month preceding the date of death? How are we going to do a valuation on February 16th? That means I have to bring in somebody, the CPA, if it's a formula or if it's an appraisal, I'm going to have to do a cutoff with financial cutoffs as of February 16th versus January 31st or December 31st of the year before.
I've had problems with that very situation of trigger days for disability concerns. And
yep.
the
very common.
The interpretation of the disability. So I go and I get, principal, I'm going to do a whole disability policy for everybody. But even that, in terms of how that thing is really worded, sometimes gets a little murky.
I mean, the idea is to be as specific as you possibly can. So the date of disability is determined by 2 licensed physicians who have examined the individual, and they've, stated as of that date that he's disabled. Well, or she's disabled. It has to be, over a specific period of time. Usually, is it 180 days from the date they ceased working, from the date they, decided not to work? You have to be specific as to the measurement of the disability date.
Could I use the definition of disability
from a disability policy?
Of the disability policy.
Yeah,
so,
but you've got to make sure that it's clear enough defined so that you can take that definition and apply it to the terms in the shareholders agreement. So you better read the disability policy and then try to apply it in the context of the shareholders agreement and ask questions to see whether or not it works. But I've had this come up before on the disability side, and the question is, well, if it's sort of vaguely referred to as, under our long-term disability policy, what if you don't have a long-term disability policy in effect at the time? Oops. So you want to have, I prefer to have specific language defining the disability, and in the absence of a long-term disability policy, I've got a definition in the shareholders agreement or the buy-sell agreement that does tell me what the issue is. Appraisers' qualifications. Some people say, well, I just want to use my CPA, who does my taxes, to do it. Well, a couple of issues with that. Are they really qualified to do an appraisal? Most of the tax accountants aren't. They're not CVAs, certified valuation analysts, or they don't have some type of credential where they've been trained to do valuations. And so how credible is that valuation if you're ever challenged by the IRS or by anyone else in a divorce? I had this come up in a divorce context. I had 3 owners. They agreed to a formula valuation which was artificially low so that it allowed entrance at a low amount and exit at a low amount. We used it for phantom stock purposes. And that was the value that was in the shareholders agreement, so that if anyone left the company or died, including the founders, that's what the value would be. Well, the divorce lawyer hired a valuation expert to come in and to show that the company was really worth more than that. And the judge took notice of that, even though under a buy-sell agreement, if they left the company, they would only get the depressed value. So you need to address all the eventualities. One of the things we usually try to do is get the spouse to sign a consent to the shareholders agreement at the time it's entered into, and then it cannot be challenged in a divorce court. I've had this issue come up. But on the appraiser's qualifications, you look at the education of the appraiser, the training, the industry experience. So I've had appraisers who are really good try to come in and value tech companies that had really unique tech assets, and they were applying discounted cash flow analysis. And I basically had the client fire the appraiser because that's just not the way you do it. You need to look at alternative ways of valuing patents and other technologies. What is the potential for a royalty stream, or what is the potential for selling this asset in the open market, and how do you establish that? It takes a lot of competitive analysis. If it's a unique asset like a patent, it may attract a much higher valuation than just a standard multiple of earnings, okay? Funding mechanisms. Standard funding mechanism, life insurance, right? We all know that, we use it. It's a great stopgap measure. It works in many cases. Doesn't work in all. If we have an uninsurable owner, life insurance is a challenge. Disability buyout insurance. I've used it. It's expensive, as you know, and it's hard to get the owners comfortable with paying the level of premiums that they would have to pay to buy disability buyout insurance. So the other piece of it, the funding mechanism, is the company able to fund the sale of the interest or the purchase of the interest with its own cash flow without damaging the company? This is where budgeting, strategic planning, and cash flow forecasting become paramount. where you all or your advisors that you know can come in and help the client figure out whether there is sufficient cash flow to fund the buyout. I'll give you an example of how we creatively did this for one client recently. I've got a company that does condo development, very successful. They've been extremely profitable over the last 25 years. Even in the downturn in the market, they still were profitable. One of the owners is 62, he wants to retire. The other one is 46. And they're trying to bring in lower levels of management into ownership. They don't know if it's going to work, but we're trying to be able to sell out the 62% owner's interest to the remaining folks, including the 46-year-old who they are 50-50 owners. And so what we did was we said, okay, what is the minimum amount that you think your interest is worth, that the company's worth today based on its cash flow that it's been generating and expected to generate over the next few years? We came up with a minimum amount, and then we had a contingent portion of the purchase price that's going to be paid by everybody out of the net profits to this guy over the next 5 years. And he's happy with that because he's going to continue working for a few years anyway, and he'll get a declining share of that profit. But that'll get him up to maybe twice the amount of the minimum amount and get him satisfied to where he wants to be. And the others are not having to go out and pay, you know, a full appraised value for the business today, which might, you know, make it very difficult either to find financing or to afford it out of the cash flow of the business or out of their own pockets.